Shares of AGF Management are trading higher today, despite the company reporting total assets under management that missed estimates in its latest quarter. On the upside, AGF saw net income that beat expectations, and revenue in its private capital segment jumped to $7.3 million. For more, we are joined by Kevin McCreadie, CEO and Chief Investment Officer at AGF Management. Thanks so much for coming in.
Always good to be here, Jacqueline.
Yeah, so the last time we talked, you were happy about 11 consecutive quarters in a row of inflows into mutual funds at AGF. It looks like that streak has been broken.
Yeah, your past opening here about the poll of the hardship faced by Canadians, we're not immune to it now, finally.
Yeah.
The industry in Canada over the last 6 quarters has lost $100 billion out. So we've been able to run positive through that until now. And when we look at it, it's not the gross sales line. Our gross sales are actually up. It's people actually redeeming, taking money out of funds and savings accounts to pay bills, mortgages, higher rates. So it really does jive with what you just saw in that polling survey. Canadians are really feeling the hardship, of these higher rates.
So do you expect that trend to continue then?
Yeah, so I think about it this way. We've gotten all the way through this rate hiking cycle. We're probably near the end. And if this is the first time we've actually turned into a negative flow, we know the next thing, if things really do soften out, is you'll start to see the Bank of Canada, other central banks start to cut rates. Right? That will drive equity markets. That will bring people back from the sidelines. It'll take a while, though, to help the people who are really suffering. But, if you start cutting rates, you could be in that cycle for a bit. And so at some point, that, too, will help repair those individuals. So I think the combo of cutting rates and driving markets, driving people back to bond markets, should bring money back to us.
Interesting that you're seeing gross sales increase, though. So where do you see the interest coming from right now?
Yeah, a lot of gross sales are still around performance. There are segments that we serve that are doing quite well. Some of our really large investor bases, which are a little bit more immune to higher rates, higher inflation, doing pretty well. The middle class is suffering. From a product standpoint, it's more global things. It's less fixed income right now. It's still some balanced account. It's things like private credit, and it's less immune to this backup in rates. So it's a broader set of things that are still going up, but by channel, it's a little softer where you expect it, the lower income and middle class.
You mentioned fixed income. Are you seeing opportunities, though, in fixed income these days?
Yeah, I think part of what's going on is you've seen this negative bond market now for a couple of quarters. We had a negative year last year. I think end investors don't understand bond math oftentimes. That rates go up, prices go down. This time, when you look at the backup we've seen just today, even over the last couple of weeks, you're probably getting close to a place where investors can safely buy into fixed income. Even things such as high yields, if you believe the recession, if we have one, will be shallow, will be okay. Even emerging market debt, things that have a coupon will be okay. There's not enough left probably in moving rates higher to offset that coupon. So there's enough coupon there. So fixed income is a place where I'd say people should start to look up, certainly after this backup.
I know the last time we spoke, you talked about being more interested in small caps versus some of the big tech companies, and we have seen a bit of a weakening when it comes to tech recently. But there has been such enthusiasm around artificial intelligence so far this year. We're going to talk about AI quite a bit more through the show. But how are you navigating the excitement around AI? Is it something where you do see opportunity, or are you being more cautious about it?
We own some of the names that play into that. AI will play out. It will have productivity components to it. But like the internet, that productivity took a decade to show up. Some of it will be more immediate. Some of it will be longer tailed, right? So I think there's some hype in some of the names, and it feels a little bit like some of the things we've seen in the past where all of a sudden everyone's raising their hand saying we're in that part of the business. But they're true winners and losers. But you're also seeing some exhaustion in some of those names when some of these names report monster quarters and yet their stocks sell off, right? Because they have had a lot of ownership. From a market perspective, when you step back, what we saw in the first half of the year, when 10 names make up most of the return, right? That's not a healthy backdrop. What we're seeing today is a little bit broadening out of the market, which I think will set up better when you start to cut rates and really try to drive demand again.
As a company at AGF, are you exploring generative AI in any way?
It's kind of funny. We laugh about this. We have a big quant team. We've been doing artificial intelligence work for 7, 8 years. Machine learning, a lot of the stuff, we didn't call it this and put a tag on it.
Right.
But we think about it discreetly, how it helps our investment processes, how we think about pulling in different kinds of data, non-structured data that we can look at to help our fundamental teams. we think about how it helps the company from a productivity lens. So I think, while it's got hype to it, a lot of companies have actually been doing parts of this for some time.
Yeah, the other sort of the earlier versions of AI versus the generative AI stuff that seems to be, I mean, it's pretty mind-blowing when you look at the capabilities of it when you play around with it.
Yeah, no, I think, but again, I think if you go back to some folks have been doing language processing, looking at, we can look at conference calls and look at for sentiment. And we do it in minutes. For every company, we can kind of look at it in a sector within a certain small period of time. So there are productivity enhancements that are certainly going to come from this.
I mentioned the TSX flirting with negative territory for the year to date. Let me just check again here. Okay, we're positive at this point, up 0.5% year to date, but it did fall into that negative year to date territory. What are you making of this September slump that we're seeing? Is this the seasonal September thing, or is it something else?
I think it's three things. One is, first, unpack the TSX. We have 30-odd% in banks. Banks are going to have a tough time here. Their funding costs are going up. Their depositors are leaving for higher instruments other places. They're starting to think about loan losses that may show up in case we have a recession, right? So you have that much making up the index, it's going to weigh on it. We have very little technology exposure as an index level here, probably less than 10%. Unlike the U.S., where you're close to 30. So the growthier part of the market that did well in the U.S., we don't have that representation here. I'd say with energy now trading in north of 90, energy company earnings will start to pick up, material companies. So there'll be some offsets from here to that bank weighing on it. I'd say the second thing is seasonality. August, September, early October, always tough. No different this time. And three, this backup in rates. People are finally maybe starting to believe that central banks aren't ready to start cutting immediately, and that we're going to be out there a little bit longer at this higher place. And that will probably bring a recession forward.